Our next speaker, or first speaker, is Rob Stanton, who has appeared. There's Rob. Rob, can you hear us?
Hello.
Fine.
I can hear you okay. Good morning.
Yeah, I'll crack on only because we are really going to be tight on time today. So there's Rob. His picture. I can't actually see his hair, so because the way he's got the camera, so I can't see whether the hair's grown or what. But okay, so you've all received a product guide this morning. I've sent to you via email. So have a look at that. I think I also sent you their criteria as well. So that's all to hand. A little bit on Rob first of all. Rob is head of sales for the Midlands division of Landbay. He joined Landbay in August 2018 after 15 years at Paragon. His expertise buy to let, and I must change that because I noticed that last time, the but to let underwriting process. It wasn't my spelling mistake, by the way. That's what I was given. So that should say buy to let, not but to let. How embarrassing. Experience obviously means he's equipped to provide brokers with the support they need in clients' applications. Rob's interest, in fact, I really do think it's more embarrassing stuff out of people. He's Landbay's resident footballer and has played against a number of ex-England internationals and has played at the majority of Premiership grounds and now tortures himself watching Aston Villa. I've not done too bad so far this year, but I've also played against ex-internationals at football, but I spent most of my time just running behind them, trying to actually chase them off the ball off of me. Or running away from someone. I played against Terry Hurlock, who played for Millwall at one stage and had a bit of a reputation, so I didn't go near him. Rob, over to you. I will see you in about 20 minutes.
Brilliant. Thanks, Tony. Thanks for the invite. I look forward to seeing the photo of your long hair on the next presentation, which will be good. So, morning everybody. As Tony said, Rob Stanton from Landbay. Here just to spend 20 minutes just to give you an overview of obviously what Landbay do, how we can help you and your clients really. We're a relatively new lender to the market. We was incorporated in 2014. So hopefully over the last 12 to 18 months, you've seen Landbay become more prominent in the market. We've got a really diverse product set now. We're really competitive with some of our products. So we're hoping that obviously we see more and more of us and hopefully you're using us, or if not, hopefully you can use us in the future. So the question I get asked quite a lot is obviously, where do you sit in the market? Who are your competitors and who does your criteria and pricing sit closely with? So 9 times out of 10, we will sit very closely to your Precises, your Paragons, your Lendinvest and your Fleets of this world. So we're very much in your more professional side of the buy-to-let market at the moment. So why should you be using Landbay? So we've got some experienced buy-to-let underwriters who you will get direct access to. So Tony was mentioning in his pre-presentation that obviously brokers having frustrations with speaking to lenders, speaking to underwriters, and speaking to their telephone team. Obviously at Landbay, as soon as a case is submitted into us, you'll actually get the direct access to the underwriter. So you can pick up the phone and speak to the underwriter at any point throughout that mortgage application. So you don't have to speak to a telephone team. You don't have to email in a generic email. You can actually pick up the phone and speak to the decision maker of that case, which we feel has helped our processes massively. Our average time to offer has come down on the back of that because obviously the service that we're offering is very good. Our turnaround time has remained at 48 hours, even throughout the pandemic. We are a fintech lender. Our whole process is online. So obviously the working from home element for our underwriters and sales team hasn't had too much impact on our processing times, which is fantastic. So obviously we have seen in the market some of the larger lenders have been struggling with their SLAs because it's been such a big change for all of their staff working from home. Whereas here at Landbay, we've been really, really good. Our SLAs have been continued to be excellent. So obviously that helps the process. So I'll talk through some criteria highlights, just to give you a flavour of what Landbay can offer. So we do have a minimum income of 15,000 for our professional landlords, and for non-professional landlords, our income is £25,000. That can be built up from multiple sources. So we can take profits from rental income, we can take employment, we can take dividend payments. So we're pretty flexible of where that income can come from. In regards to flats, we can consider new build and conversions, up to a maximum of 5 stories. That has reduced recently with obviously the cladding issues that we've seen in the market, but we're hoping to move back up to unlimited number of stories in the near future. Now we've been getting some good valuation reports and some good commentary from the market. Limited companies are acceptable to us, and we can lend up to 1.5 million, up to a maximum 70% loan to value. And all our 5-year fixed rates are calculated at pay rate. So if you are really struggling to get the maximum borrowing out for your clients, please do consider lenders that offer pay rate deals, and Landbay are one of them lenders. So we will be able to assist and help your clients get the maximum out of their property. Day one remortgages, I have a slide on that a little bit later on in the presentation. And we've recently launched some 80% buy-to-let products as well. So there's only a few lenders in this market at the moment who are offering 80%. So again, if you've got clients who really want to take it up to the maximum loan to value, obviously please do consider Landbay. Capital raising only excludes tax and gambling debts. So if you've got clients who are looking for onward going purchases, or even clients who haven't found that onward going purchase at the moment, we're happy to release the funds to the client so they're in a position where they can move quickly and buy that onward going purchase. So we don't ask for simultaneous onward going purchase. So if you have got a client who's looking to buy in the next few months, they haven't quite found that property at the moment, and they want the monies in the bank so they can get a quick deal over the line, then obviously Landbay can help with that as well. In regards to tenant types, student let, DSSS, all acceptable. And we also consider interfamily sales as well. So obviously we're seeing a big increase in potentially mum and dad who are portfolio landlords looking to move some properties into their children's name. That transaction has to be done at open market value, and it has to be done as a purchase, but we're happy with the equity that's held in that property to be used as the deposit. So potentially the son and daughter don't need that 20 or 25% deposit sitting in their bank. We're happy for the mum and dad to gift them the equity to get that transaction over the line. And again, we're one of few lenders in the market, especially in the buy-to-let space, that offer some tracker rates with no ERCs. So it really does give your clients the flexibility to sell that property without having any ERCs attached to that product. So again, that's a real good product that we've got there in the market. And if you need any more information about that, please do give me a call. One of our good selling points is that we're very good at portfolios. Obviously, as you know, in the market, a lot of lenders now have portfolio restrictions and they have different stressing around their portfolio. At Landbay, our background portfolio has to meet 125 at 5%, which is really, really competitive. And we don't have a maximum on loan to value. So if you have got a landlord who's got a large portfolio and it doesn't meet the stressing of some of our competitors, the high street banks, please do give us a call. So HMOs and multi-unit freehold blocks, it's a big part of our criteria, and we can consider lending up to a maximum of 12 units on an MUFB and also 12 rooms on a HMO, which is really, really good. We do require the clients to have 12 months lettings experience, which is quite competitive, as some of our competitors ask for 2 years or 3 years. So if you are dealing with landlords who are looking to purchase or remortgage HMOs and multi-unit freehold blocks, Landbay can help up to a maximum of 12 units as long as they have 12 months lettings experience. At Landbay, we also offer 3 types of valuations, which is really, really attractive. So the first one is your standard valuation, which is simple. It's your bricks and mortar valuation. And 9 times out of 10, that's what lenders will use. It'll be used for a single family rental value, and comparables will be obtained from the open market via Rightmove or Zoopla. Here at Landbay, we actually consider investment valuations for the properties which are let to multiple tenants. So it'll be for your HMOs and multi-unit freehold blocks. So obviously the value is slightly different. The value is calculated via a rental multiplier and annual rental income. So for the right property in the right area, which is key, your clients could potentially get at an increased property value by obtaining an investment valuation report, which is absolutely fantastic. As I say, it is very much driven by area and location, which is key. So the value will have to confirm that there are similar properties that are let in the same manner for us to obtain a valuation report on it. It is a real good USP of Landbay. I do get a lot of calls from brokers asking about investment valuation reports, and I haven't got too long to go over it today. But again, if you need any more information on the investment valuation reports and how it might help your clients, please do pick up the phone, give me a call. I'm more than happy to talk it through with you in some more details. And we also do a Red Book commercial valuation report. Because we go up to your 12 beds and your 12 units, it's very difficult to obtain comparable evidence for that type of property. There isn't many 12-bedroom HMOs or 12-bedroom MUFBs in close proximity to each other. So the valuer has to do a more in-depth valuation report, taking commentary from the area. So it'll be motorway links, it'll be universities, it'll be hospitals. So if you ever dealt with a more commercial valuation report, you're probably looking at a 30 or 40 page valuation as opposed to a 3 or 4 standard valuation. So it's just to give you an idea that we don't have one valuation fits all. We do a valuation for each individual property unit, which will hopefully benefit the client and get value out of that valuation report. Limited companies, pretty standard in the market. So we do SPVs and we do day one limited company setups. We don't take any floating charges or debentures, and we're happy for the same solicitor to act for both us and the client. So we don't ask for dual representation, which will keep the cost down for the client, because a lot of lenders out there will say they want a solicitor acting for the client as well as the lender, and the client has to pay for both sets of fees. Whereas at Landbay, we're happy to use one solicitor that can act for both parties, which is good. We're also a little bit more flexible when it comes to limited companies. It has to be an SPV, but we're okay with holding company situation as well, which we've seen a lot more of in the market. And I'll use this as an example. So we've got Smith Enterprises, where the directors are Mr. and Mrs. Smith, and they both own 50% shares on that limited company. That limited company is predominantly a development company. It doesn't have to be a development company; it can be any type of company. But it's not an SPV set up for buying and holding residential property. So not many lenders would lend to Smith Enterprises. So what Mr. and Mrs. Smith have done, they've set another limited company up sitting behind or underneath Smith Enterprises as Smith Property Enterprises. And this Smith Property Enterprises is going to be used to buy and retain buy-to-let properties. The way they structure Smith Property Enterprises is by Mr. and Mrs. Smith being directors, but the shareholder being Smith Enterprises. This allows the client then to transfer monies, intercompany loans between the two companies, so they haven't got to extract that monies, pay tax on it, and then incorporate it into Smith Property Enterprises. So we are a little bit more flexible when it comes to the more complex limited company structures that we're kind of seeing on the back of accountants and tax specialists speaking to their clients. So again, if you have anything that doesn't normally fit the box, it's kind of outside your normal parameters, again, please give us a call. We're more than happy to kind of look through these applications before you submit them onto our portal. As I mentioned earlier, we do day one remortgages as well, which is great. So obviously, if you've got a property which is unsuitable day one, your clients can purchase via cash or bridge. As soon as the works are completed, we'll lend based on the open market valuation, subject to works being done within the first 6 months, and we can lend up to 75% loan to value on that. So it's really good for your clients who are potentially purchasing for cash or at bridge. They're spending their own monies to do the works, but we'll remortgage it straight away to the open market valuation. So your clients can pull out the money that they've invested on that property, the money that they've spent doing the works of that property, enable them to go on to their next property or their next project and do the same over again. So we haven't got the 6 or 12 month rule that we do see in the market, which is very, very good. So stress testing is also a big part to the market. Obviously, we're seeing a lot of different lenders offering different stress tests in regards to maximum loans. And I mentioned previously that Landbay consider pay rate. So I thought I'd put a slide in there just to really show you what kind of difference you can get from going to a lender that offers pay rate deals as opposed to non-pay rate deals. So this is an example of a 5-year fixed rate. Client is looking to remortgage or purchase via a limited company, an SPV, and the rental income is £1,000 per calendar month. The client is looking for a maximum 75% loan to value. Some of our mainstream competitors will stress that at 125 at a flat rate of 4.5%, meaning that your clients can get a maximum loan of about 213,000 out of that property. Whereas at Landbay, on today's rates, we could actually lend £279,069. So there is a significant increase in maximum loan, which we could get out of that property for your clients just by going to a pay rate deal. So again, it's also worth considering. Obviously, I know we all use sourcing systems. Obviously, some of the mainstream competitors will be priced a little bit better than Landbay, but you might not be able to get the maximum loan out of them properties. So although we might not be sourcing 1 or 2 in the sourcing system, we will be on the first page. So please do kind of look down that sourcing system. Life doesn't end after kind of lender 1 or lender 2 on the sourcing system. There are lenders underneath who can kind of offer different products and different scenarios to really kind of help your clients get the maximum out of the property. We've also offered free indemnity insurance as well. Obviously, we were proactive in thinking, obviously, the 31st of March was going to be a cliff edge, obviously, the stamp duty. So we took it on ourselves to see how we could help clients, how we could help get deals over the line to make it easier. We all know that solicitors are struggling. We all know that local authorities are struggling. So we were thinking of ways of how we could help their clients. So obviously, in short, we've actually introduced free indemnity insurance. And indemnity insurance allows completion after about 5 days of getting a mortgage offer out, because there won't be any local authority searches, there won't be any building or planning insurance searches. So it does enable the client to complete very, very fast. So it takes the pressure off everybody to get them deals over the line, which is very good. Indemnity insurance is pretty new in the buy-to-let market. There isn't many of us out there that obviously offer it, but it's gone down really, really well with our broker partners, and our clients who are actually using us at the moment to get these deals over the line, which is fantastic. Obviously, we have had the extension yesterday, which I think is good. And obviously, we have got a little bit more time to get them deals over the line, which will help. But even away from that, free indemnity insurance does help massively as well, because it does take the pressure off everybody and it does get the completion done very, very quickly. You might have seen in the market yesterday, we actually launched some new rates. We've actually launched some non-portfolio products. So obviously we've got some portfolio products out there in the market. We're obviously now trying to enter the non-portfolio section of the market, which is for your landlords who own less than 3 properties in essence. And obviously, as you can see from the rates, they're very competitive at 3.44 on a 75% 5-year fixed rate. And again, the ICR will be stressed at that 3.44. So actually, we're looking into a more simplified market. So from an underwriting perspective, it should be a lot more simplified, because we won't be asking for portfolio, cash flows, business plans, because the landlords we'll be lending to will be amateur landlords or non-portfolio landlords. So they should all be showing on the sourcing system today, which is great. And again, if you need any more questions about how we can help on the non-portfolio products, please do give me a shout. But as you can see, or hopefully see, Landbay are kind of diversifying quite nicely. We've got some nice products out there now. Our criteria is evolving and our processes are very, very good. So I'll wrap through that quite quickly. There was a lot to get in. There's a lot more to know about Landbay, but hopefully that's given you an overview of obviously where we sit. You've probably seen Landbay sourcing a little bit more, really not knowing who we are, where we sit, or what kind of our criteria is. So hopefully kind of the 15, 20 minutes that I've just given you has given you an idea of who we are and how we can help. And obviously, I'm sure Tony will send some details out about contact details, but please feel free to pick up the phone, give us a call. We're happy to help as much as possible.
Thank you, Rob. As you can see, any documentation you need, we've got a particular part. We're an accredited packager with Landbay, so which we were taking on last year for that particular service. So anything you need, you can find within our website. We've got a dedicated phone number for Landbay and also a dedicated email address for Landbay, as you can see. So it will get through to the right people every single time. Basically, any questions? We've got a couple of questions, although I'll come to the first question sort of like later on. But so, Rob, will Landbay do first-time buyer, first-time landlords?
We don't, unfortunately, at the moment. No, we used to consider first-time buyer, first-time landlords, but the criteria around it is our minimum income had to be kind of £75,000. So it just didn't really fit in the market to a certain degree. So it wasn't something that we was overly competitive with. So unfortunately, we don't do first-time buyer, first-time landlords, but first-time landlords is acceptable to us. Okay.
And just so everyone's aware, if you've not seen this before, we always have some pre-prepared questions just in case nobody does ask a question. So Rob, your product range offers HMO and multi-unit freehold block products. Are landlords still actively looking into this property type?
Yeah. At Landbay, we've continued to see good volumes of business on both HMOs and multi-unit freehold blocks. There's still relatively strong demand in the market for them type of products, which is good. Throughout the pandemic, Landbay didn't stop lending on HMOs or multi-unit freehold blocks, and a few lenders in the market did, because I think they were concerned with the student accommodation potentially not going back. But there is really still good demand. Obviously, there's been articles in the press that we've all seen that people are flocking to the hillsides and the countrysides, obviously when lockdown's over, obviously because they want to get some fresh air and have some bigger gardens. Landbay actually undertook a recent survey asking certain questions, and the feedback that we got from intermediaries and landlords was that the demand is still in the city centres. People are going to be flocking back to the offices when things open. So we don't really see a huge drop in demand for HMOs or multi-units across the board, which is fantastic, because the yield is so much better as well. So yeah, the demand is still there.
Okay, a question from Ricky. Do you do bridging? No, Ricky, sorry, Landbay don't, unfortunately. I've got two more questions. That's all we're going to be able to take with the time we've got. So Gavin's asked, can you do holiday lets like Airbnbs owned through limited companies?
Watch this space. Not at the moment, unfortunately, Gavin. It is something that we hopefully moving into relatively soon. So as it is today, no, but watch this space, and as soon as we do, obviously we'll make sure that it's publicised so you're fully aware.
Okay, final question from Paula. Do you do flats over commercial, retail, or even semi-commercial?
So we can consider properties above, adjacent to commercial properties. Has to be on a separate title away from the commercial element. And the only commercial elements that we're not really comfortable with is fast food or pubs or restaurants. So anything away from fast food, pubs and restaurant, we're more than happy to consider lending to a property which is above or adjacent to a commercial property.
Okay. Rob mentioned about the new products being launched yesterday. I will be talking about this later on. We do have our own internal sourcing system that we use for the specialist finance market. And so Landbay launched their products yesterday, along with 4 others. Our sourcing systems are bang up to date. So we have, sometimes you do find that some of the sourcing systems aren't that quick to actually get these on board. Although probably Landbay are the ones who actually update these, I should imagine. So if they've already done them, they should be fine. But certainly ours is bang up to date. So we're able to quote as of today. Rob, we are absolutely, you get gold star, the first gold star of today for being bang on time. We've got 50 seconds of your slot left. So I'll pinch that 50 seconds if I can, so I can give it to the next person. Rob, absolutely brilliant as always. Thank you very much. We will
no worries. Thank you, guys. See you later.
Bye. So what we're going to do is we've covered that part. Okay, so next speaker, Gaynor Morgan of Yorkshire Building Society Commercial Mortgages. A little bit tough. So first of all, we've sent you this morning. So this is part of what Gaynor is going to be covering today. So you would have had this on email this morning. Even those you've had a couple of, we've had 6 people so far who've actually registered since 10 o'clock. So I've managed to get these out to everybody. So if you haven't got these, just don't message me because I'm obviously looking at the screen, but message one of the team that's been involved before, and they will make sure that you get these come over to you, or check your spam, of course. Okay, so a little bit about Gaynor first of all. She's been with Yorkshire Building Society, which is previously probably known better as Norwich and Peterborough Building Society, for almost 17 years. 10 years working in residential lending, moving on, then went on to commercial lending, where she's been almost 7 years. Has experience in dealing with commercial investments, owner-occupied loans, corporate and personal buy-to-lets. Over the course, this makes me really jealous actually, this next part. Over the course of years within the finance industry, Gaynor has enjoyed developing her knowledge and skill set and has completed her CMAP, DIP, BB and C, and she's currently studying her DIP FA. In fact, we did try and contact her yesterday, and she then apologised. Oh, sorry, I was doing an exam. So me being someone who's taken one exam since 1979, which was my CMAP, which I'm not an exam person, unfortunately, even though I come from a family of school teachers. So Gaynor's interesting fact is she's a 2nd degree black belt. Don't mess with Gaynor, guys. I tell you, and this is all true, by the way. I've actually obviously all true. I've looked all this up just to make sure there's no sort of claims being made. And she's won numerous British, European, and world titles over the years, and has had the honour to travel around the world to do so. And this is also very true. Gaynor's won 2 Peterborough Sportswoman of the Year awards over the years. I think the last one was it 2016, Gaynor, or 15?
Yeah, I think about 2016.
So when Gaynor declines one of our deals, we don't argue. just so everyone's aware, because just in case we see her in 6 months' time. So Gaynor, I think it's now should be over to you. Yes, it is. It's over to you. So I'll see you in 20 minutes.
Fantastic. Thank you very much. Hi, everyone. Thank you, Tony, for the introduction and the opportunity, obviously, to speak to you all today. As Tony mentioned, my name is Gaynor and I'm one of the relationship directors here at the YBS. As also mentioned on there, I've been with the society now for nearly 17 years, the last 7 years more so in the commercial department. As you can imagine, over the course of those years, there's been many changes to the business and the society, but probably none more so prominent than in the last couple of years. Again, as mentioned before, we were previously the NMP, following the merger with YBS in 2011. We took the plunge 2 years ago to rebrand and relaunch as YBS Commercial Mortgages, which is what you see today. Over the course of the last 2 years, as well as the rebranding, there have been many new developments here at the YBS, which has included the growth of our team. And we have recently established 3 new hubs based in Birmingham, Manchester and Bristol, which adds to the existing hub already here in Peterborough. As with most lenders, we've seen many changes in the market considerably over the last 12 months as a result of COVID. The society took the decision not to withdraw from the market during that period, although we did recognise that we needed to take precautions on our offerings during that time, but we have still tried to be able to support our introducers and customers by being able to offer some sort of offering during that period. So as an initial result of that, we did reduce some of our loan to values. We did also reduce the appetite around certain sectors. However, the months following that initial decision, we have been gradually been able to re-enter into those markets and also increase the loan to values back up to our normal sort of levels. I'll now take the opportunity to run through the slideshow that Tony's popped up on the screen. So let me just go through to the next page. Bear with me a second. So the first screen that you'll see up is in relation to our buy-to-let products, something that we've always been in the market for, predominantly around your limited company customers. So the first product as detailed on there is the corporate buy-to-let, which is available to limited company and LLPs. We can offer up to 75% loan to value for these customers. However, that is restricted to 65% if we're lending on a new build flat. New build flats is something that we would say has been built or converted within the last 2 years and hasn't been let in its current format for the last 2 years. So anything that falls within that is 65% loan to value. That doesn't apply the same to a new build house. A new build house would be 75% loan to value still. Products available are either a 5-year fixed rate or a 10-year fixed rate. So the 10-year fixed rate, as you can see on there, is 3.7%. Your 5-year fixed rate is governed by the loan to value that you're looking at. So if you're looking at a 65% proposal, you're looking at a 3.4% rate. 75% loan to value, and you're looking at 3.55%. Minimum loan on this product is 500,000 and the maximum loan per letting unit is £1 million unless you're in London and South East, and it's 1.5 million. We are able to consider multi-unit freehold blocks of flats. We generally go up to 20 in a block. If it's a new build block of flats, then typically you're up to 16 in those. One important thing to highlight on the multi-unit freehold blocks for us is if there's more than 5 units in that block, then we will be looking at the valuer to give us a block value as opposed to lending on the individual values of the flats. Lending is always based on the lower of the passing rent or the market rent, which obviously can be dictated by the valuer in his report. We are able to offer full interest only for the term of the mortgage, which is what we generally see for most of our customers. Capital and interest or part and part is available, though, if that is their preferred option. and generally we are looking for your standard construction properties. We've recently been able to extend into the large personal buy-to-let market, although our offering around this area is a little bit more restricted than the corporate side. This is due to our link with Accord Mortgages, who are also under the YBS banner, and obviously, as many of you probably already deal with Accord, they are big in the personal buy-to-let market. So for personal buy-to-lets, we're able to consider loans for 1.5 million upwards where there is 6 or more properties attached to that, or 3 million where, irrespective of the number of properties that we're looking to lend. The loans and the pay rates are exactly the same as what you'd get on a corporate buy-to-let, so the 3.4, 3.55 or the 3.7 depending on the product. The only difference is the stress calculation is slightly higher for the personal buy-to-lets as opposed to the corporate buy-to-lets, which you can see on the screen in front of you. ERCs are exactly the same dependent on which product you elect, so you're only tied in for the term of the fixed rate period. Same arrangement fees, 1.25% with a procuration fee of 0.75% paid to the introducer. Following the fixed rate period, the loan does revert to our standard SVR, which is currently 4.49%. Also on the screen, you'll see the details of holiday lets. As we've seen in the last 12 months, obviously staycations have become more of a thing. Obviously, still at the moment a little bit restricted, but it is obviously becoming a lot more popular, especially with people reluctant to travel abroad. We do only have one product at present in this market, which is the 5-year fixed rate 3.85%, as you'll see on the screen in front. Again, the arrangement fee attached to that is exactly the same as the other buy-to-lets, along with the procuration fee. You will, however, see a difference in the minimum loan amount, which is £400,000 for these specific products. Maximum loan per unit is 1 million on that. Interest cover is worked on the net income. So the net income for us is looking at the gross holiday let, less any actual letting agents costs and less any business rates if they're applicable. And then the calculations is 125% interest cover at either 5% or pay rate plus 1%, whichever is the higher. When it comes to the holiday lets, we're not looking for properties that are restricted to only be used as holiday lets. So if somebody can only stay in the property for 10 months of the year, that wouldn't be something for us, because we would be looking for it to be able to use as an alternative as a residential or a standard buy-to-let on a standard AST. Outside of that, SVRs, again, following your fixed rate period, and ERCs are exactly the same as the other products attached for the 5-year fixed rate. Currently not in the market for first-time landlords, so we'd only be able to look at applications where a customer had 12 months plus letting experience to be able to consider sort of any of our buy-to-let products. Moving on to the next screen. Is onto our commercial range. So the site is in the market for both commercial investment and owner-occupied proposals. This is something that we've done for many years, and again, as I said, we've continued to do throughout the COVID experience. All of our loans are individually priced and are done on the merits of the application. Certain things that we take into consideration when we're pricing them is you're looking at the loan amounts, the loan to value, location of the property, type of security that's on offer and the type of tenant, the lease term and break options that are attached to that, as well as looking at the overall background of the client and their experience. One thing to mention for our investments is that we're not looking for the term of the lease in place to the tenant to run for the full length of the mortgage. Very rarely do we now see that you're having people that signing into 15, 20-year leases with no breaks. I don't think I've come across one of those in the last 5 years. So we understand that, but what we're looking for is either at the end of the first break option or the end of the term is for the debt to be down to sort of 65% at that point. Generally speaking, most of our loans are priced between sort of 3.5% to 4.5% above the Bank of England base rates. And on the screen, you'll see the different sectors that we're able to consider when looking at an investment or an owner-occupied proposal. So you can see sort of for the investments, offices, professional practices, essential retails. I say essential retail being as things that have been able to operate and continue to trade during COVID. Nurseries, takeaways, obviously we can look up to 65% loan to value. Anything sort of more industrial, sort of warehousing and storage, we are able to go up to 75% for those. As it stands at the moment, we aren't in the market for your hospitality and leisure sectors, such as your pubs, hotels and restaurants. Obviously, they are the areas that have been biggest affected as COVID. They were also areas that we weren't massively involved in pre-COVID. So as a result, we took to withdraw from those sectors at this current time. Obviously, as things start to progress more and businesses are opening back up more, then hopefully we'll be able to revisit those areas and offer some products within those as well. That side, as I said, we have continued to offer commercial investments in the other areas during the whole of the COVID period. Recently, we've launched a new semi-commercial product, which you'll see is the first line on the products on top of the slide. This is aimed at properties where 50% or more of the capital value is from a residential element. We're able to go up to 70% loan to value. We have a 5-year fixed rate at 4.7%. And for the first 5 years, we can offer full interest only at that 70%. After the 5 years, the rate will convert to our SVR, which I said was 4.49% earlier, and then the loan would convert to a capital and interest repayment basis for the remainder of the term. Minimum loan amount on that is 400,000. That is slightly different to our general appetite, which is 500,000 across the board, other than the holiday let, which I obviously mentioned earlier. Outside of semi-commercial product, most of our commercial loans are on a capital and interest repayment basis. However, we are able to consider part and part or potentially 5 years interest only, with the remainder of the loan being on a capital and interest repayment basis for some of the other elements. If it's a pure retail or pure office investment, then we would just be a full capital and interest repayment from day one. Repayment coverage on our commercial investments is 100% debt service requirement, and that's either at 7.25% or pay rate plus 3.25%, whichever is higher. If someone is looking for an owner-occupied, then we would be using the EBITDA to calculate the repayment coverage. Again, that's 100%, 7.25% or pay rate plus 3.25%. If you've got somebody who is looking for an owner-occupied property, they may buy semi-commercial and want to rent the residential above, then we can look to take the income that they'd receive from the residential into factor before we calculate the stress coverage along with the EBITDA. Or if they buy two commercial units, they're going to occupy one and rent the other, then we look to take the rent from that other into consideration. Also, if they're currently paying rent for another property that they're going to vacate, then we can look to add that back in before we calculate the EBITDA. Again, we aren't in the market for first-time landlords, so for us to be able to consider commercial investments at this time, or we would be looking for the client to have sort of 2 years experience within the commercial market. Arrangement fees, 1.5%, procuration fee of 1% payable on those. Terms up to 25 years, as it mentions on there. Generally across the board, our minimum loan amount is 500,000, with the exception of obviously those that I've already highlighted, which is your semi-commercial product at 400,000 and the holiday let at 400,000. The minimum loan of 500,000 though is an aggregated loan. So if you've got somebody who's got 2 properties and the combined debt they want to borrow is over 500, that's fine. Or if it's just 1 property, that's fine as well. Loan terms we can consider from 5 to 25 years. We're generally looking at taking the applicant up to the age of 75. If you've got more than 1 party attached to the loan, we can look to work on the youngest party when we're sort of looking at the length of the term we're happy to go to. We can lend to new SPVs, established investment companies or existing trading companies. We don't force a client to set up a brand new company every time they want to buy an investment. So it's entirely up to them how they want to structure that. We don't insist on taking any business banking. Quite simply, we don't offer any banking facilities. So it's not something that's in our radar. And we're also generally not looking to take any debentures into consideration. Our first, obviously, thoughts against lending is that the property is sufficient to cover what we're looking to lend. If we're lending to a corporate entity, we will be looking at taking personal guarantees from the directors and shareholders. And if it's a commercial investment, we're looking at an assignment of rents from the tenants. So debentures is way down that list of our considerations. Lend in England and Wales. We're not currently lending in Scotland at present, although this may be an area in the future that we do go into, but as for now, it's not. We're generally lending against the lower of the purchase price, market value or vacant possession value. The only exception to that is if we're lending to a commercial investment where the tenant is a blue chip, which we would use as a definition as Dun & Bradshaw and has a rating of 4A1 and above, then we can potentially look to base the lending on the market value if that is higher than the vacant possession. Where we're lending to a brand new customer, we can obviously go up to 75% loan to value for loans up to 5 million. Anything over 5 million, then we're restricted to 65%. If the customer's been with us for more than 3 years, then once over that £5 million, we can look to still lend to 75% loan to value. We are a bricks and mortar lender. We look to take consideration for alternative use of a property. We look at the desirability of a property in terms of its relet and resale period. We also understand at this time that there are many people that have made use of CBILS loans and bounce back loans. For somebody who has taken those into account, and borrowing, we don't automatically penalise them for having done so. Each loan is looked at on its own individual merits and circumstances. We understand one shoe does not fit all. Obviously, we'll be looking to understand how people have been impacted by COVID, and whether that's directly as a business themselves or whether it's the rental income that they receive from their portfolio. Currently not lending into HMOs or student lets, although again this is a market we are looking to explore into, and there are already talks into getting products launched into that area. Sorry if that's been a bit sort of rushed through. Obviously just want to make sure I get as much in for you guys as possible, and I will hand back to Tony.
Excellent. Bang on. Actually, you're 25 seconds over, Gaynor, unfortunately. On that.
I'm sorry.
We haven't got many. You're fine, don't worry. We haven't got many questions. We got one question, which I'm actually going to hold up, which is when was the new semi-commercial product launched? There you go, if you can see that. January. There's the broker terms. We haven't been asked any questions by any delegates, so I've got some. Here's some I prepared earlier. How would a delegate go about submitting an application to YBS?
Okay, so we obviously have a panel of introducers. It's not an open panel, it is a restricted panel, which Tony and the guys at the specialist are on our panel. So if anybody did want to submit an application through to ourselves, then you would need to contact Tony and the team to submit an application through to us for us to process. Tony's obviously got all of our details. He's been more than happy to share sort of my contact details with you if you wanted to discuss anything. But once it is an application that's ready to move forward, it would be Tony and the team that would take that forward with us.
Okay, and in fact, if I just go towards the end, I'll just ask one question just whilst I'm doing this, but Vikas has asked, do you consider commercial units?
I hope so. Yeah, so commercial, as I said, is fine with us. It could be semi-commercial, it could be full commercial, whether that's industrial, retail, not a problem. So if there's something that particularly you want to have a chat over, as I said, industrial units, yes, industrial units. Yeah, fine for us, can go up to 75% for industrial units. So yes, no problem.
Okay, I mentioned our sourcing system earlier on. I don't think you'll find any of YBS's products on any sourcing systems out there. We could be wrong, but
no, I don't believe we do upload to any.
Every one of their products is on our sourcing system, which quite simply means within a minute we'll know whether it qualifies under the rental service ratio, the debt service cover ratios needed for the rental, the whole lot, LTVs, type of properties, everything. Okay, so we've got that. Now we've still got just over 2 minutes left, so I've got a couple more I can probably ask you, Andrea. Will you lend with adverse in the background?
So we're predominantly not an adverse lender. Obviously, we understand people have had blips here and there, and circumstances do arise. And I think everyone would be an idiot to not think that that's going to occur. So if there is anything that is adverse in the background, I would recommend that somebody does call us to discuss that prior to any application being submitted.
One thing I'll be covering later on is what we do as a company when we're submitting a case on behalf of an introducer. One thing we are is very thorough. I'll be talking later about Equifax searches, Experian searches, land registry searches. We've got Experian commercial, so we'll look at the customer's background, just to make sure he hasn't got a string of failed companies behind him that went bust owing loads and loads of money to loads and loads of people, that sort of things. We don't want to waste Gaynor's time. We don't want to waste your time. So we are very thorough right at the outset. So, okay, let's just see if there's anything else I could ask you. Will you lend on HMO and student lets?
So, as mentioned at the moment, HMOs and student lets aren't in our appetite. There is talks for a product to be launched in those areas. So, keep your eyes peeled, and hopefully that will be something in the coming months.
Okay, Gaynor, thank you very, very much indeed. Great as always. And bang on within time, you also get the gold star. You get the second one of the day. In fact, you're 25 seconds.
I think you were just scared not to give it to me.
Absolutely. Yeah, there's that as well. But I could probably run. Actually, I can't run faster than you, so I'm too old. I will say thank you and say goodbye, and we'll get our next speaker on.
Thank you very much, everyone.
Thank you, Gaynor. Here he is. There's Pete. Pete, can you hear us?
Hi, Tony. I can hear you. Yeah.
Excellent. Okay, I'll crack on with your introduction because you've got your 25 minutes as well.
Yeah.
So, just so you're aware, whilst the Gaynor was speaking, I knocked up this. So if any speaker sees this, 2 minutes remaining, it's my 2-minute warning that you're talking too much.
Tell me to get off.
Okay, so I'm going to give Pete a little bit of introduction. First of all, everyone, you should have received this. First of all, just see a nice picture of Pete. As you can see, his hair is also going out of control between that photo being taken pre-COVID and now. I've known Pete a long, long time, by the way. So one of the nicest guys in the marketplace as well. And
Good to say that.
Doesn't look like he's carrying any COVID weight either. I did make your photo. I did actually narrow it, Pete, just to make you look a little bit slimmer in the photo.
Appreciate that.
That's no problem at all. It's all part of the service. Okay, so everyone, you should have received this. We've knocked this up ourselves because Glenhawk don't really have a product guide as such at the moment. They've just got some terms. So we've knocked this up ourselves. You've received this morning, hopefully. And I think it's a 4-page document. So a little bit about Pete. His role, obviously, as BDM is to build relationships with brokers, help them structure do the works. And he's also available during the process to help any broker or client to ensure the process is as smooth as possible. We are an accredited packager with Glenhawk, so we get more than if you were to go to them direct. So it means we can package on your behalf. A little bit, Pete, and again, Pete, and I've done this before, but I'm really sorry about the next slide. So Pete's claim to fame is that he once appeared on a Persil advert on TV Age 7. When you go into Google and put in Pete Turner Persil advert, this photograph comes up. So there you go. That's Pete with hair all the way
Look at
back.
that hair.
That's 1985, I believe, Pete. Is that right?
1985,
yeah.
1970.
I was being kind. Hopefully, he didn't wash the dog with Persil. The dog's looking very clean, actually, but hopefully it wasn't because of the Persil. So, Pete, over to you. It's all yours. See you in 20 minutes.
Brilliant. Thanks, Tony. Appreciate that. Right. Hi, everyone. as Tony said, Pete Turner from Glenhawk. Just going to move on to the next slide. Okay, so excuse me, Glenhawk was set up in 2018 by Guy Harrington. There's a lovely picture of the handsome man. He is an experienced developer himself, and basically was using various lenders, wasn't happy with some of the service he was getting, also some of the fees and terms and things changing. So set up Glenhawk with Nick Hilton, who's got many years experience as a lender himself. And yeah, set up Glenhawk in 2018. So we're approaching our 3rd birthday. And we've just moved into new premises as well. So hopefully once lockdown finishes, we'll be able to have a party and celebrate that. Just a few milestones for the company. So set up in 2018. Just point out a couple of things I think are quite important, mildly interesting. We set up with our own money to start with. We then got a funding line within our first year with Shawbrook Bank, which was for 75 million. That was replaced very fortuitously just before lockdown, actually 2 weeks before the first lockdown, by a 200 million facility from JP Morgan. It was JP Morgan's first bridging facility in the UK. So very proud that they supported us. What they also did during lockdown is continue to support us. So we honoured our pipeline, and we continued to write new business, although we did have to kind of pull back on some loan to values and some property types. But you know, for the right deal, for the right client, we continued lending through the first lockdown and have actually continued ever since. We have lent out currently, well, I think it's about 180 million up to date. And what's probably quite nice is that we've actually had over 100 million of that back in as well. So you know, I think it proves that we lend to the right customers, lend on the right deals, and also our communication with the customers and also with our introducers is that, you know, we help people basically pay us back. You know, if they're going to retain the properties, they can get cheaper money on buy-to-lets, on commercial deals. So, you know, get rid of our debtors as soon as you can. So we work with you all to do that. Okay, so just next slide. Why partner with us? And I'm sure if you, I think there's been some other bridging lenders on here, or there will be, we'd probably say the same sort of things. So, you know, speed. We can get terms out normally within a couple of hours, probably 4 hours or so max. Rates are competitive in our market. Fee wise, there's no hidden fees. We charge an arrangement fee. We charge an insurance fee of 495 on completion. Direct contact, and even though it is JP Morgan funding, you know, it's us. We can be flexible. We can take views on things. Yeah, we can take a commercial view. So you know, we like to, if we say yes to deal up front, then you know we honour that unless anything jumps out at valuation or at legals. Okay, so our core offering, as I say, so we're a principal lender. We don't have a rate card, so we price every deal depending on what the asset is, what loan to value is being requested, and the client's profile, which is very important to us. So what's their asset and liability like? We wouldn't lend to a first-time owner, first-time investor. So as long as someone has got at least a residential property or another investment property in the background, then we would look to assist them. You have one underwriter that will see the case from start to finish. We've got 5 underwriters at the moment. Interest is accrues daily, charged monthly. So we don't, you know, if you redeem the loan on the 3rd of the month, we don't charge the whole month's interest. It's literally just those 3 days. Arrangement fees are normally 2%. We can play around with those if you don't want to charge the customer so much. That's something that can be negotiated with us and with Tony. We don't charge any exit fees, although we do have a minimum term of 3 months. But after that, there's no fees involved for redeeming us. So no admin fees, no early redemption fees. Something that might stand us out a little bit different is that we lend on open market value. Now that's open market value on residential. What can be slightly confusing is on semi-commercial and commercial property. We do lend off the vacant possession value, but it is vacant possession open market value, whereas a lot of other lenders could work off the 180-day or the 90-day figure. So I actually had an inquiry that we issued terms on last month. Client chose to go with a different lender. They've had the valuation done, and the lender has changed their mind from lending on open market value to the 180-day value. And there's a £200,000 difference in that figure. So they've coming back to us. Basically, I'm hoping to get the application in on that one tomorrow. Something's a little unusual as well. I think a few lenders do it, but if someone is buying under value, then we can lend the lower of 90% of the purchase price, or 75% of the open market value if it's residential, or 65% if it's commercial. We can rebridge, and we see quite a lot of it with COVID. Delays in getting works done, delays in sales. We're comfortable in looking at that. Obviously, we will understand why it needs to be rebridged, but generally, say COVID, want a bit more longer on the market. That's a fine reason for us. We've always lent in England and Wales, and recently we started lending in Scotland. At the moment, that's restricted to the Edinburgh and Glasgow postcodes, but any of the ones kind of around the edge is something we can consider, and I think we will be expanding into further cities within Scotland very soon. So watch this space. Okay, just some of the our specialities. Again, there's other lenders that will do the same thing. So we can lend to onshore, so UK and offshore trusts. So again, another quick example. We had a inquiry come in, which is a Jersey trust, but the ultimate beneficiaries or ultimate owners are UK. So we're very happy lending to them. Couple of things to push out. We can lend to non-UK nationals as long as they've got UK property already and UK footprint. Auction purchases, so you'll normally get 21 or 28 days to complete from when you pay your 10% deposit. At the moment, that is not a problem for us. Obviously, we're relying on valuers and solicitors, but if we've got an active broker, an active client, then that's fine. Discounted purchases I've already covered. We can look at refurbs, and I'll go into that in a further slide. Short leases, we can lend on a property that's got a lease of 70 years remaining at the end of the term of our loan. We've done quite a few where it's been less than that, but the client is actually paying to extend the lease on completion. So again, we can lend on that increased value, either 90% of the original purchase price or 75% of that increased lease value. And we can consider adverse. So we'd obviously want to know the story. If I'm being honest with you, if it's missed mortgage payments, that's probably going to be very difficult. But if the CCJs, there's a story behind it, if they're satisfied or will be satisfied, then we can certainly consider those. And other missed payments, late payments, defaults, again, story and overall client profile. But that's things that we can bottom out early if you're aware of them, if your client has actually told you, which sometimes they don't, funny enough. Just to go through the individual products. So bog standard, residential bridging, and this is across the board for all our products or property types. Loan size 250 to 5 million. On residential, say 75% of open market value. We can lend to individuals, businesses, say offshore SPVs is fine. Just thought I'd run through a couple of examples of some kind of very brief case studies. But we completed our first deal in Scotland last week, which was good. We started lending beginning of December. Now this was actually we were lending to a UK trust on a residential property in Edinburgh. It was a refinance from a private bank mortgage that had reached the end of its term, and they were going to sell it, but had basically run out of time with a private lender. So we lent, it ended up being 69% loan to value. The loan was just under £2 million, but the structure was quite complicated. So we had to get obviously a Scottish lawyer to deal with taking the security on the property. We had to use one of our English lawyers to look at the trust document and do the KYC for the individuals. So that kind of came up probably halfway through the process. So it was a bit of a kind of banana skin, but we managed to negotiate that. And again, very active and motivated broker and client. And we completed that at the, let's say, last Friday, which met the deadline to redeem the existing borrower. We do quite a few developer exits, or some people call them marketing loans. So if you've got a developer that's finished 10 properties, basically needs to repay the existing finance or wants to take some profit out before they sell, then we can look at those. And that can be on single units or multiple units. We can lend up to 75% on that. And basically then just take the sale proceeds as and when those sales happen. That's quite a popular thing at the moment, especially with developers who want to move on to the next site or the site after that. Couple of other things we've done where someone has bought a property for cash, maybe refurbished it with their own money, waiting to sell it or waiting to move it onto a buy-to-let, and has found the next property. So need the money quickly to secure that sale. We're quite happy to capital raise on those types of properties as well. So auctions fall into that category as well. Okay, so the next one is our refurbishment loan. So now this can actually cover residential, commercial and semi-commercial property. So if we look at residential first, we can lend, say, up to 75% of the open market value on day one. We can then lend up to 100% of the refurb or conversion costs, up to a maximum overall loan of 65% of the end value. Now, the only kind of caveats within that is that the refurb or conversion costs can't be more than 50% of the day one property value, or £500,000. So if it's more than 50% of day one or more than £500,000, in our view, that's development finance, which isn't something we offer. So most of the things that we see will be someone looking to buy something and do a very quick tart and turn, so new kitchen, bathroom, and then put it back on the market, or put it onto a buy-to-let. The other ones we see are someone looking to buy a residential property, say a 4 or 5 bedroom house, convert it into an HMO, house multi-occupancy. So again, we can look at the end HMO being up to a 10-bed property. One inquiry that we issued some terms on earlier in the week was someone that was looking to buy a property, do a bit of a tart and turn on it, so not a lot of money, and to be honest, the uplift in value wasn't that significant. The value to the client was that there was a large garden that had a planning application declined in the past. They had been speaking to the local planning officers and a couple of architects and had worked out that they could get a property on there. They just couldn't get what the original person had applied for. So their profit was effectively in that planning. So the refurb washed its face, but I say, you know, long term, they would then split that title, sell the house, we get redeemed. They can then use that plot of land with the planning and build it out with another lender. And that's where they were going to make their money. So we'd always look at a deal and, you know, does it make sense? Why is the customer doing it? And that came to us after the broker had spoken to a couple of other lenders who said that they didn't understand why the customer was doing it, which seems a bit strange to me, but I guess sometimes it's how it's presented to the lender as well. But, you know, if you ask the right questions, then you can normally get to the bottom of why someone's doing it. And these guys had, I think they had 7 or 8 properties in the background. They'd done something similar before, so just makes sense. Okay, we are lending on commercial property again. We did have a little stop on it for a few months during lockdown, but we're back in that market again. We have recently increased the cap. We had a cap of 500,000 per loan, but that's just been released back up to the higher figure now. So we can look at larger loans on those. Again, a couple of examples for that I've had recently. One was where customers had purchased a large commercial office block with a view to refurbishing it, which they completed, and they almost had it like a serviced offices now. So the existing lender wanted their money back. So we're looking at doing a dev exit on a commercial property pending sale. We've issued terms on that at 65% of £3 million. So you know, it's a nice chunky loan for us up in Manchester. Another one we've got is where someone wants to buy. They're currently renting commercial premises for their business. They're an interior design company. They want to go and buy basically some commercial space in London to use as their offices, but also do some other offices in there they could let out. So on that basis, we're lending them 65% of the vacant possession value on day one, and we're lending them 100% of their refurb costs. Now, something I should have mentioned on the refurb product, when we lend the costs, they're lent in arrears and in tranches. So, for example, this one, the refurb costs are 370,000, and I think we're releasing those in 4 tranches. So the customer will spend the first quarter of whatever 370,000 is. Can't work that one out that quick. We will then get an asset manager or a quantity surveyor to go and confirm that that work's been done. We then release that money back to them for them to go and do the second part. Okay, so what we don't do, and I know some other lenders do, which can cause some problems, is that they will get the property revalued at each drawdown stage. Now, obviously, if you buy something and rip it apart, the value probably could have gone down. So are you going to be able to get that tranche of money back? All we do is get the QS or the asset manager to confirm the work's been spent, and we will then release that money to you. Normally takes 2 or 3 days from receipt of the asset manager or QS report to confirm the work on that. We also do second charge bridging. So that can be, it's only on residential property. It can be on main residence, but it needs to be for business purposes. So it becomes unregulated, or we can do it across buy-to-lets or multi-unit blocks, HMO, something like that. We want the first charge lender to be a high street lender rather than another bridging or development lender. So as long as that's okay, we're fine with that. Again, another very quick example of something I had in yesterday was customer has got 5 or 6 buy-to-lets. Main residence is worth 2 million. There's a first charge to Barclays of 650, and basically they want to raise £500,000, which is to go into a newly set up company that will be buying, refurbing and flipping properties. They also may retain a few. So we've actually agreed we'll do an 18-month term, and our repayment from that will be drip fed in profits from the flips or from the remortgages as well. The backup is, if that doesn't happen, then the customer's got the income, which the broker's confirmed could provide us with a refinance if need be. So we'll always look at how we're going to get our money back, I guess, and just working with the broker as to, if it's something they're involved with, who's it likely to be, where's it likely to go. The last slide, I think I've not had the 2-minute warning yet, but I must be getting pretty close to it. Is we now look at regulated bridging, which we brought out in end of last year. Thanks, Tony. So slightly different criteria on that is that the loans from 150 to 1.5 million, loan to value is 65%. Now we can do first charge and second charges, but we can't do a standalone second charge regulated loan. So if you've got someone that's downsizing or upsizing and wants to give us a second charge on what they currently own and a first on what they're buying, then that's fine, and we charge at the first charge rate. So haven't got the product guide there. I don't know whether that was part of what Tony sent out, but I can forward it on. Is we are probably the kind of middle of the road lender, I would say, on regulated. So we're not cheap, as in, if you're regulated, you do precise your UTBs at 0.4s. We start at 0.65. Where you will maybe need to use us is where it's a slightly unusual transaction, and we have one with Tony. We'll accept refurbs on the property being purchased or the one that's due to be sold. We will consider some adverse where other lenders won't. But it's gone down. It's gone down okay. I think we'll tweak it. It was a kind of dip a toe in the water, and there'll be further enhancements that will make it much more competitive over the next few months. So, Tony, that is me done. Thank you very much.
24 seconds in, another gold star going to be launched here. Right, okay, I've got no questions. By the way, this slide just tells you if you need any documentation related to Glenhawk, just go online and you can grab whatever you need within our website. We have got some questions. I'm going to actually jump down to, so Paul has been putting a few things in, and I owe everyone an apology. I've sent everyone the wrong Glenhawk guide this morning. I've sent them the one from last August. So once we finish today, I'll get you over the one. We have done it. It's just that I've sent the wrong one. So I'm going to get that done at the end of today. You'll all get the new guide that has all the new bits and pieces in there.
Oh, thanks, Tony.
Because Glenhawk don't really have anything as such that we can actually issue to you as far as what the rates are, etc. But okay, so the other questions we've got. So bear me on a second because the print on this is absolutely tiny. So Sue has said, you brushed over the mezzanine on the timeline. Are you offering mezz slices?
No, sorry, we're not. That's actually a funding line into us. So I don't know much I can say. So JP Morgan provide us with a certain percentage on each deal. We then, from our own equity, fund the rest of it. The mezzanine that was mentioned in that timeline is actually another funding line into us. So basically, it means we put less of our own money into the deal. It means we can do more. We can write more deals. So no, it's not a mezzanine facility we offer to our customers.
Okay.
Excuse me.
Couple more. Do you offer ground-up development finance?
I'm going with a couple of no's here. No, we don't. I think it's a product that we will be looking at this year. So no, at the moment it's literally heavy refurbs as per the criteria that I mentioned. We haven't got the experience, the infrastructure to deal with ground-up development, and it's something actually that JP Morgan don't like.
Okay, final question is, and hopefully I think I know the answer to this one, which should be, do you allow commercial to resi conversion on the commercial bridging loan, or would it be the refurbishment bridge product?
Yes, we do. We kind of, even though we break it down as products, we haven't really got codes for products. So yeah, commercial to resi is something we can do. We've got a one we completed end of last year, which was a 2-story office block that was being converted into 30 flats under permitted development rights. They'd started the work, they'd done 1 floor, and the existing lender wouldn't lend them any more money. So we stepped in, repaid the existing debt, and we're doing tranches for them to convert the first floor. So yeah, something we can look at, and I'm very happy to lend on.
Okay, Pete, thank you very much. As Sandeep just said, thanks for your presentation. He said it's good to see you.
Thanks, Sandeep.
And as it is for all of us. So Pete, thank you very much indeed. So what we do, everyone, we're going to Pete's going to wave goodbye, and we're going to put on a slide that's just going to tell you when we're coming back. So we'll have a short break. So we've got some different options here, as you can see. So depending on how long everyone takes. So we're back at 11:40 with our final 2 presentations, and then my bit right at the end. So see you in, what is that, 7 minutes. Okay, next speaker is Kerry Bradley. Hair's looking a lot longer, Kerry. Blimey. Okay. Can you hear us? Kerry?
Right, so.
Can you hear us?
Can you hear me now?
Yeah, we can hear you. That's fine. Yeah, can hear you.
I can't hear you. No, I can hear you.
You can. Brilliant. Okay, so right. So there's Kerry's obviously pre-COVID picture because the hair's a lot longer now. It's really weird sometimes. We haven't seen somebody for quite a while because Kerry obviously was someone who comes into our office quite frequently. It's just weird when you haven't seen him for a while and to see how things have changed. So she's probably looking at me thinking, look at the state of his hair. So anyway, Kerry, you would have received this morning from us, which is UTB's product guide across a couple of products. A little bit of an introduction for Kerry, first of all. She's been she's very experienced BDM. She's been at UTB for 2.5 years. Her role is within the specialist mortgage side of things rather than bridging and the other parts that UTB offer. Her area is the south, and she helps providing residential and second charge loans for brokers for a load of different purposes. First in property remortgaging, raising capital in property for a variety of purposes, as it says there. She enjoyed spending time with her 7-year-old son. Is he still 7, Kerry, or has he got any older? Has he had an 8th birthday yet? Because I think this
he's 8 now. Yes.
Okay,
yes.
There you go. So whilst we've actually been doing this, he's turned 8. So socialising with family and friends, and a new puppy called Mabel, who's not so new anymore, I believe, is keeping the family busy. I do love this bit. A good night in would be watching a crime drama or one of the Real Housewives shows. A guilty, probably also, I should imagine, Married at First Sight Australia currently with a G&T.
Oh, absolutely, yes.
A Prosecco. It sounds exactly like my wife. It really does. Honestly, it's spooky. Okay, Kerry's interesting fact: she's a keen upcycler of furniture and also enjoys cooking. She's also a keen Spurs fan, I'm a West Ham fan. And as a teenager, many years ago, that's her words, not mine, by the way, she played for Haringey Girls 5-a-side team. So, Kerry, over to you. We're a couple of minutes in, so I'll let you crack on. I'll see you in about 20 minutes.
Thank you. So good morning, everyone. Nice to see you all, for you to see me. Hopefully you will find my presentation of use to you. So there's a slight delay here. Obviously, Tony's introduced myself to you also. I'll just sort of give you a very brief oversight. So I've been at the bank now for 2.5 years. I specialise in first and second charge residential products for the bank. And I've been within financial services now for over 20 years. So I'd like to think I do have a relatively good grasp on the specialist lending sector for you all, if you do have any questions. I'm just going to run through my presentation and talk about sort of who we are at the bank, what we do. I'm also going to talk about our products, property types, the people that we lend to, and then obviously Q&As at the end for everybody, if that's okay. So I'm just going to start off with a little bit of an introduction to UTB if people aren't aware of obviously what we do at the bank. So some people may not be aware that actually we've been established since 1955. The business itself established through retail deposits and development finance lending. We then obviously saw quite a significant growth over the years, and it was in 2010 we launched into into the bridging finance sector. So we offer regulated first and second charge bridging, very competitively priced, rates starting at 0.48%. We do sort of light refurb, heavy refurb, and we can do cross charging as well within the product sector. We then obviously in 2011 moved into asset finance, which obviously covers, as you imagine, asset finance lending for hire purchase, finance lease, refinance, with a wide range of other additional lending for engineer and construction types. It wasn't until 2015 we actually launched ourselves within the second charge mortgage market. This has seen a significant growth for us, and in fact, news off the press, there will be an announcement on Tuesday. We are revamping our second charge product range, so watch this space. We are probably known in the market for non-standard construction types, different various sources of income. Properties are quite varied. We have a new numerous different types of products available, fixed rates, tracker rates, with or without ERCs. So it's a significant amount of products, which I will talk further into the presentation with you. Back in 2019, we then stepped into the first charge lending market. So this covers us for first charge residential, and now I'm pleased to say last week we launched into the first time buyer market. So we actually now have a suite of products within the first charge range, which include standard purchase, remortgage, unencumbered lending, interest only lending, and first time buyer lending. So again, quite a nice, diverse and varied product suite within the first charge product range as well, which I will talk further into the presentation. I've put 2020 there and beyond because I think it's everyone's big question. What is beyond 2020, the year that changed the world? I think the key thing for us is to understand that obviously we were very prominent, and I'd like to say proud to have continued lending throughout 2020 and the pandemic. We did not stop lending when everything decided to change. We continued to lend. In fact, we enhanced our product range by launching a broker support package throughout the pandemic, where every week or every 2 weeks we were launching an enhancement to our existing range to support our broker and our partners in making sure that we had products to be able to sell. So it gave you an opportunity to continue to work with us. So we're proud of the fact that we were able to continue to lend throughout the pandemic. 2021 for us is already starting out very well. We've just launched first time buyers. We have an enhanced mortgage portal, which we are launching at the back end of March/April, which will give an integrated DIP process to our mortgage introducers and our mortgage packaging partners. We are just launching an enhanced product range to our second charges on Tuesday. So I would say we are very much in the growth, and fintech is going to be quite a key area for us within this year. So again, watch this space. Moving on to the next slide, I'm going to talk through some of the key areas of lending for us. So I think it's skipped there by about 3. She says, okay, so who do we lend to? So I want to start with the sort of the people that we lend to, which is always quite key, because obviously when you're placing business, you need to establish who do we lend to. Now, the key thing for us, we can lend to employed, self-employed contractors, and we can use additional as income. So let me start with employed applicants. We can work with clients that are on 0 contract hours, bank hours, or even have a second job income scenarios. So for example, if you have somebody that's on a 0 contract hours, we can consider them as long as they've got an 18-month history. We can consider clients that have minimum time within their job. So we have 2 different variances here, which again is quite a flexible approach. If you have a client that has a continuous employment history for over 12 months, but has only been in their current role for 3 months, not in probation, we can accept them day one. If you have another scenario where the client has only been in their role for 6 months and doesn't have a 12-month continuous employment history previously, we can still accept them as long as they've been in that role for 6 months and not in probation. So that would cover clients such as clients that have been travelling, working abroad for a period of time, that may have been people that have stayed at home to raise their families, or it could well be that people just had to take sabbaticals or career breaks. So as long as they've got that 6 months in current role, we can consider them for our lending purposes. Again, we can also accept clients who've got second jobs, and the key thing for us, as long as they don't exceed a 50-hour working week, we can use any additional income sourced from that purposes. Overtime and bonuses. So again, if you are a key worker or your overtime and bonuses form part of your contract of employment, we can use up to 100% of that as income. If they don't form a normal part of your contract of employment, but you can prove a solid history of receiving overtime or bonus income over an 18-month period, we can then use up to 50% of that as a source of income. Moving on to self-employed income, we can accept sole traders, limited company and partnerships. For our sole traders and partnership income sources, we require 2 years evidence of SA 302s, and we will always work off both for sole traders and limited companies the most recent year's figures. So we actually don't work out an average of the last 2 or 3 years. We use the most up-to-date figures submitted to HMRC. We can work off, we also have the flexibility of looking at salaries drawn and dividends drawn for limited companies, whereas sole traders and partnerships, we will work off retained profits. So again, there's a slight difference in that. If you're not quite sure, please give us a call and we'll be happy to talk it through with you further. Or if you'd like to give a specialist caller directly, they'll obviously be able to assist you as well. Just moving on to contractors, again, we launched this, we sort of revamped the product sort of early last year. So now we can accept contractors that have 1 year trading with accounts. We will work off a contractor on a day rate over a 48-week period, and we can accept UK-based umbrella properties within that. So if you've got a client that's a sole trader in theory as a contractor, or has an umbrella company as a contractor, we can consider that through our underwriting process. If you have somebody that has a limited company and they are sole director of a limited company, we will obviously allow only 1 year trading. However, we will look at the salary and dividends drawn and not the pay rate. So just be aware of that when it comes to our underwrite. And finally, with regards to additional income, we can accept things like benefit income. Now, the 3 benefits that we will accept will be working tax credits, child tax credits and child benefits. If you have clients that are in receipt of pension income, we can accept state pension and work pension as well, and private pensions. So again, we can accept a multiple of different various sources of additional income. We also obviously lend into retirement. So I'm not sure if you're aware that we actually start lending from the age of 18 up to 85. So we do a lot of lending that is post-retirement age of 70 and can go up to the age of 85 as long as the clients redeem the loan before their 85th birthday. Now, just moving on to the next slide. It's taking a while to load, so I do apologise. Thank you for bearing with me. So this is probably the key USP for us within UT, or for me personally anyway, talking about the product ranges. What properties do we accept? We have 3 types of rules, and the type 1 is that we don't restrict the loan to value depending on the property type. So this is obviously quite key for us as well. So if you have an example of certain lenders out within the marketplace, they tend to sort of categorise the properties by type, and that type will have a restriction on the loan to value. For us, we will accept properties of non-standard construction within our product range up to, on occasion, 80% loan to value. So that could cover concrete, PRCs, Mordic, type construction, timber frames, single skin, graded buildings. A lot of what we do happens to be masonettes or flats above commercial, shops, restaurants, takeaways, and so forth. So again, we have the flexibility of lending on properties that are above, also adjacent to commercial elements. The key factors for us: is the property traditional to area, is the property habitable, and is there any risk to our security? So as long as the value for our lending purposes confirms that to us, we're happy to lend against it. We do a lot of other types of lending, such as properties that have annexes attached to them. We've done some recently where we've had a few holiday lets on a piece of land that happens to have a larger residential home on it. We've again agreed to do that. We've done refinance on that, and we've done second charge lending on that. So again, there's quite a lot of properties that we will accept, things like large farmhouses that may have an outbuilding that they use for an office or a sort of a light business purpose. The key thing for us that we were looking for less than 40% of the asset to have any type of commercial or working from home or office type of scenarios. If you're not quite sure, pick up the phone, give us a call. We're happy to talk it through. One of the other key areas that we lend to as well is high rise. Now, again, as long as the property has the relevant certificates in place in regards to safety, we don't restrict the number of floors of the block. We will lend on shared balcony access, deck access scenarios. So again, if you're not quite sure, let us know. Again, the multitude of different assets we can lend to is quite great. And again, the key thing is, in theory, so the best example I can give you is that we could be lending on an ex-local authority flat that happens to be above a newsagent's that has a shared balcony access. that may be a precast concrete as a weird example. In theory, we could lend between 75 and 80% loan to value on those types of assets. So again, very, very key USP for us at the bank. Just moving on to the next slide now. So just give me a moment. Now, this is our product range. So this is quite a varied, and this is where we're going to real depth about the USPs. Obviously, reasons why you would think to come to us, obviously, aside from the property types that I've already explained to you. So no credit score, which is quite thin. Now, we are a bank, and which surprises a lot of people that we don't actually use a credit search or credit score. If you have clients that have adverse, we have obviously what we call near and near prime products. So when no credit score comes into account, it gives it a lot more placeability for us to lend, because we don't actually at the moment we don't actually build in credit score or have a decision in principle, which obviously makes the decisions. Everything we do, which is why people come to us, we offer a flexible underwriting approach. Everything is manually. We can assess cases manually. We get a lot of referrals. We actually have a referrals help desk where if you've got cases that slightly fall out of non-conforming, or you're not quite sure what plan it falls on, whether it's a prime plan, which is our 0 status plan, or our 1 or 2 status plans, we have a team available to look at those referrals for you. If you've got a credit search that you're looking at, not quite sure what plans it's going to place on, again, this is the support that we can give and specialist finance can give with regards to placing the case potentially with us on our plans. Now, obviously, having no credit scores, as I mentioned, opens up quite a large door of opportunity. I've mentioned earlier that we lend from 18 to 85, so again, that gives a greater scope of applicants that we can look to support. And one of the other key USPs for us is that we can accept married sole applicants as well with our borrowing. So again, we get quite a lot of those situations where clients have got a property on a first charge, titles in sole name, they've got married. We can accept the second applicant coming on and not being on the first charge. That's absolutely fine. We do a lot of transactions where we're doing equity buyouts, change of titles. So again, a lot of transactional purposes go through with regards to sort of the types of borrowing that we can do on first and second charge products. Now, everything I am talking about here, just to mention again, is covered for first and second charge products. The criteria that we hold very much mirrors each other. With regards to prime and our near prime product range, now this is one of the second, or for me, the biggest USP at the bank is how we profile a customer. Now, to us, a prime customer is somebody that has had no missed mortgage payments or secured arrears in the last 12 months, has had no all their unsecured credit is up to date. Now, when we mean up to date, it's showing as 0 on their credit file. Now, this is what sets us apart a little bit differently to other lenders. If you've got a customer that's running with the credit file for, say, on the credit file, it's showing 1, 1, 1, 2, 3, 4, 5, 6, and it's just about to default, but they pay off that debt as showing as 0, we will ignore all those missed payments down. So again, that gives the flexibility of obviously putting it onto a prime product for us. If you've got somebody that has had a missed mortgage payment in the last 12 months, and they can prove they paid it within a 28-day period of the original due date, we will ignore that as a missed payment and put it down as a late payment only, and we would disregard that off the credit file. So again, it could then potentially move the whole dynamic of the case going from a 1 status deal to a 0 status deal. So this is going to give you an opportunity to get a lower rate and higher loan to values, and obviously product pricing as well is quite key. If you've got somebody that's had unsecured debt and they're showing their credit profile is showing, say, 5 payments down across multiple products, and they want to do a debt consult to get it right, as long as they haven't had a missed mortgage payment in the last 12 months, i.e. missed, not late, we can put them on a status 1 plan, which again, pricing is very competitive for where it sits. And again, we can go up to 70-75% loan to value for those types of lending. And that also applies to our status 2 product range, which again, if they've got unsecured missed payments and they're all running at sort of 3 or 4 or 5 payments down across multiple items, they don't have to bring it back up to get it onto a plan. There is another plan available. So again, if you're not quite sure, please let us know. With regards to the rates and that we offer, I've mentioned this earlier, we have interest only available for our first charge product range. At the moment, our second charge lending is based on capital repayments. We have fixed rates available across the whole product ranges. So we have 2, 3 and 5 year fixed with ERCs. Then we offer a 5-year fixed rate product without ERCs. And on our zero status customers, depending on the loan to value, we do have base rate lifetime trackers available as well with no ERCs. So as I've mentioned before, there's quite a lot of variety in regards to the products that we have available, which hopefully you will see on the product guides that Tony and the team at Specialist have been able to provide to you. One of the other key areas for us at the bank is the loan purpose, that we can offer. So this comes into probably any legal purpose is probably the best thing for me to say is that we can offer. So debt consolidation, home improvements is probably the biggest one for us that we do. Also, I'd like to stress at this point, we can do multiple reasons for loan purpose. So another example that we had recently where we did 32 separate levels of credit disbursements to a client, which, as you can imagine, to the dismay of my underwriter, having to sort of do a disbursement for that level was quite significant. However, it just goes to show that we have the flexible approach to do that. We also do debt consolidation for tax bills, divorce, buy-to-let, onward holiday home purchases, onward purchases of land for self-development, any legal purpose. If you're not quite sure, give me a call. There are certain restrictions in regards to capital injection into businesses, but that's something that we can talk out later. I can see Tony's come on, so I've just run over slightly, so I have a habit of talking. So just to summarise for you, the key thing for us at United Trust Bank is that we are a flexible lender. We are non-conforming to the high streets. We sit comfortably behind and alongside some challenger banks out there. And I think the key thing for us is to understand that when you work with us or you utilise with us, we are a life cycle lender. We're a life cycle bank. As you've seen, we've been trading since 1955 and we continue to want to and will continue trading for a significant number of years going forward. We will always enhancing our product ranges, and I would say within the next 4 to 6 weeks, we are revamping our criteria on second charges, which will be happening very shortly. We've just launched first time buyers, which inevitably will add in another level of products. We are launching an integrated portal very shortly as well, which will allow anyone to come to us to get decisions in principles done, and it will have a bespoke online document upload. It will give you a very clear document checklist and submission route, and it will also give you live case tracking. And we've already integrated an Equifax decision tool within our existing portal, so again to speed up our service and keep us. And the good thing as well with our SLAs, we will acknowledge and review an application into us on a day one review within 48 hours currently, and we're actioning post emails into the office within a 24-hour. So we are really within the service levels at the moment. I would sort of hand it back to Tony now. I would say thank you very much for your time and patience. I hope you found the presentation useful, and obviously opening up for questions. Thank you very much.
On the slide there, thank you, Kerry. On the slide there, again, any documentation you need, decision in principle forms, app forms, again, all on our website, easily obtainable. We're going to the questions. So I've only got a couple of questions, actually. The first question, I think, probably answers itself. Will UTB do first-time buyer, first-time landlords? You're not in the actual buy-to-let space at this moment in time.
We are not, no. But there is a roadmap potentially that we are looking to offer maybe second charges on buy-to-lets in the next next part of the roadmap journey, but it's coming. But yes, we can do first-time buyers on purchase.
Okay, and as far as lending into retirement is concerned, do you need pension projections or just proof of payment into a pension?
It depends on the timescales from when they're going into lending into retirement. So typically, if they're over sort of 15 years away from their retirement age, we just need to see that they have a pension. If it's within the 15 years of retirement age, we need to see a pension statement.
One last question. Terry's asked, what is UTB's max income multiple?
Oh, good question. So for second charges, we can go up to 6 times income for zero status clients. So what we deem as prime. If there are 1 and 2 status, it drops to 4.5 times income. For first charges up to 60%, first charge purchase remortgage, we do 5 times income up to 60% loan to value, and then it's 4.5 times for first time buyers on thereafter borrowing over 60% if they're second time buyers and home movers. So there's a bit of a variance there. So, but everything is detailed in our product guides on the criteria section on the right hand side at the bottom, which breaks it down depending on what status they're in and what product it's for.
And again, as I mentioned earlier, all of UTB's products, first and second charge, and regulated bridging, unregulated bridging, are all in our sourcing systems that we use, so we can give you quotes within seconds. Someone else is typing. We have got about a minute. So if it's a very quick question, I'll ask it, but it's not appeared. So if it doesn't appear in the next few seconds, I'll have to go on to the next speaker. If not, we can answer. I'll tell you what we'll do. We'll answer it afterwards, everyone, because we are fairly tight on time today. And I don't want to be sort of like still talking at 1:45 this afternoon. So, Kerry, thank you very much indeed. Really appreciate it.
Thank you.
And we'll see you very soon, hopefully face to face very, very soon as well. So,
hopefully, yes. Thank you.
Here. So our next speaker is Ian Harrison, and believe me, when you do see him, he will not look like that photograph. Because in fact, we can't really tell. He's got a beard by the look of things now. You'll understand why in a moment. So next speaker, Ian Harrison, who is with Affirmative Finance. Affirmative are in the bridging and development space. You would receive this information from us this morning. Affirmative don't really have any product guides as such with regards to rates, but Ian will be covering that in his presentation. But I've sent you this morning because this is what we have for a previous show that he presented at. A little bit about Ian. He's now in his 18th year at Affirmative and has been there from the start, watching growth from a 4-person operation to 30 plus employees. And Affirmative are more of a family than your average lender. He's been in the industry for 35 years plus, working in the finance industry, started as an IFA mortgage broker before moving into consumer finance, then banking before working in the bridging industry for Affirmative. And like many other people in the same job, he's worn many hats and understands the needs of the client, the broker, and the lender. His interesting fact, which is what I mentioned right at the start, he's certainly the only person I know over the pandemic to have lost some weight, now 3 stone, which is quite outstanding. I think he's probably given it to me, unfortunately. That's the problem I've got. But absolutely amazing. Well done, Ian. I need to know your secret. But tell us another time, because you've got a lot of slides to go through, and we're now, you've got about 24 minutes to do so, or even less than that. So, Ian, over to you.
Good morning, everyone, and thank you for the comments, Sue. I mean, I've actually shaved it. It's quite nice and trim today. I did look like Father Christmas. Right, I'll just whiz through this as fast as I possibly can. My name's Ian Harrison. I'm from Affirmative Finance. And it's not moving. Tony, it's not moving forward. It's just a quick recap there. We were established back in February 2004. We're now coming up to 18 years. We specialise in what I call fast short-term finance. Since 2007, when the crash happened, we moved into development. And because we are a regulated lender, we can actually do residential builds as well as now multi-units. Over the last couple of months, I seem to have been doing barn conversion after barn conversion, spookily enough. And if you look on my LinkedIn profile, I've actually got a running one for the last few months, which is a work in progress, which is moving quite sort of nicely. Unlike many other lenders, we have actually got our own in-house legal team. So when you've got a case that might be awkward or there's time constraints, we can move really, really quickly. The 2 owners of the companies are qualified lawyers. So when you get a deal, it's getting looked at not just as an underwriter, it's getting the legal view as well. We do not charge anything up front. The only fee a client can pay is the valuation fee, and that's directly to the valuer. We don't charge any sort of admin fee or take a cut of the valuation, which many other lenders do. We say we do loans from 10,000, ideally it's 20,000 with the fees, and we probably cap out at about 3 million. Over the years, I make sure the team are really, really committed to service. And on top of that, there's a personal service of my own. I'll look at doing whatever I can for the client. You know what I mean? So if it's site visits by one of my BDMs, site visits by an underwriter, the solicitor to check out a plan, it's something what we'll look at. Members of the Council Mortgage Lenders, which is now UK Finance, and then we've got the other things, patrons of the NACFB, lending partner of FIBA, and I do the training for the bridging and development side, Association of Short-Term Lenders. But the big thing about Affirmative is the can-do attitude. If we see a deal and you think it can be done, we will do our utmost to try and do that deal. When you get a deal from Affirmative, one of the things what you've got to look at is Affirmative is actually 4 trading styles. Well, there's actually 6, but there's only 4 which we sort of publish on our documentation. So if you do see any of these logos or any of these names, do not think that we've brokered it out or sub-brokered it out to anyone else. It's just different trading styles through the development, first charge, second charge, regulated, unregulated, types of cases what we get. So if you do see anything like that, please just they are all Affirmative companies. It's just a group of companies there. We like to look outside the box on certain things. As I mentioned, we're fully regulated, but we are a true spade in the ground development. We're there from the land being purchased with maybe planning permission, and we work right the way through. I know many lenders say they're a development lender, but the true fact is it's only when it's new builds and the property is completed. If the roof needs to come off, it's too heavy or too heavy a refurbishment for them. We are there from the foundations upwards, the roof coming off. We're a true development lender, and we do it quite differently to anyone else. We do an awful lot of auction purchases, and with the auction purchases come unmortgageable properties, whether it's got no roof, no electrics, no problem to us. We can look at doing it all day long. I have got a specialist auction purchase, which I'll go through in a minute, but refurbishments and time-sensitive cases are just everything what we do in our bag. And I'm sorry for talking so quickly. This normally takes an hour, so just get through it. I won't bore you with what bridging finance is, but many brokers actually think because it's bridging, it's a little bit quicker. It's a mortgage, you know what I mean? So we'll usually go a first or a second charge, okay? So the odd occasion we can do it as a third. The fastest deal I've done is actually 4 hours. On average, it's between 7 to 10 working days. Okay, but it all depends how good the client's lawyers are and how quickly the valuation's paid for. When I go back to sort of my days, I was a bank manager with HSBC. And when I moved into the bridging market, I actually looked at what the broker knowledge was of who needed bridging finance. And if you go back 18 years ago, it was for chain break. And then it was for the possibility that someone had pulled out of the property. You've then had it with auctions. But I actually come up with 18 different ways to do bridging finance. I changed the way you looked at it. So it wasn't just the unmortgageable properties, etc. Now, one of the things I looked at a while ago is I incorporated something which is rather cheesily called the Frequent Flyer program. And everyone was starting to watch Channel 4. And with Channel 4, it either became naked bodies, recipes on different food types, or what I called the property porn. So everyone all of a sudden thought that they could go into property and deal with it. But when you looked at these figures, 42% of the property across the UK was highly geared. By highly geared, I mean 50% or more. 32% was lowly geared, which was 50% or less, which meant 26% was unencumbered. So what I realized is people would have property they might have inherited or they paid off the mortgage, which they could then gear to use as some sort of bridging finance. So when property became more and more, how can I put it, appetizing to people, and they were then looking at becoming investors, how many of your clients have got more than one buy to let? I came up with a scheme where people could buy property easier. So just by looking at this slide, it'd mean that about 58% of the property across the UK could be utilised in some form for bridging finance. So what you're looking for is, if you've got your professional landlord, your small portfolio, developers that might sell some, keep some, and then the accidental landlords where, as I mentioned, is where someone might have inherited the property. Okay, so as you go through it, let's say someone's got a property that's unencumbered and it's small, it's 200,000. They then go to the local auction and they see a property which they can buy for 75,000. What they can do is actually come to me prior to the auction, and I can arrange a facility on the bank of property up to £150,000, say. They know on the day of the auction that if they bid, they can buy the property, do any essential repairs. The property goes from being the worst one in the street to the best. The property is valued at 120. They refinance it out at 70%. They've now got a 30k property uplift, but the bank of property is then unencumbered. So over a period of time, the bank of property can be utilised more and more. So just think each one of these is a repeat client for yourself. Each one is a repeat purchase. Each one's a repeat buy-to-let. It's a different commission structure for you that's ongoing. I've got clients that will do one of these every 3 months or every 6 months. So they've been building a portfolio up. They're not having to always what I call downward spiral. So it'd be bridged out, or sorry, mortgaged out at 75%. So they buy one at 70. So if you've got a property at 200, you'd refinance it 150, then you go to 112, 85. So it's not downward. You've always got the 200 grand property to fall back on. Just a couple of examples what we can do outside it. I don't know if you've noticed the MOD are selling off property, the NHS, the coal boards, and there's some bargains to be had on the development side. So if anyone's got any questions on these, so I'm not sort of whizzing through them all, it just come back to me. But we've got plenty where you've got properties that are being refurbished, properties that are being developed. You've then got it where some of the bigger house builders will sell at a discount. So we can arrange the finance for the likes of Persimmon, Redrow, etc., where they've got quarterly and 6 monthly targets to complete. We can look at paying through the discounts there. You then obviously got the auction purchase, which you can use the frequent flyer program. Or what you can look at doing is, if someone's looking at property, let us know before the auction and we can look at the property. We can give you terms on what it is. We can use either funds, which you might have here to disposal, or we can put a charge on another asset. One of the things which Affirmative, it does really, really well is what I call outside the box thinking. So, and on one of the other ones, presentations before, I noticed they didn't do tax bills. We will do a tax bill or tax resolution so long as the client has got the ability to refinance away from us. So whether it is a VAT bill or it's a personal tax bill, as long as that client can refinance away and we can be repaid, whether it's the sale of the property or a remortgage, we will look at it. But we will look at the majority of deals right the way through. Okay, one of the things what I've noticed over lockdown was there seemed to be an awful uplift in the lifetime mortgages and equity release market. What people don't realise is the properties need to be up to a certain standard. So let's say, for example, you've got someone who's bought a house back in 1950, 1960. They've not done much work to it. The kitchen and bathroom need to be brought up. I had one this week where the roof needed to be replaced. The lifetime mortgage company mightn't do it. The property might be unencumbered or lowly geared. We can do a small advance of 10, 20, 25,000 pounds, bring the property up to a standard that then can be refinanced on the lifetime mortgage. So from having no commission, the broker's now got 2 bites of a little bit of commission on the bridge, then the commission on the equity release. Okay, it's just something what we're looking at. I mean, it's just different things and different views what we've got. The huge thing with ourselves at the moment in time is I reckon about 80-85% of whatever we do is some sort of enhancements or some sort of development finance. Okay, so what you're looking at is this is a case where someone's bought a property in an area what they look at. Okay, so they've bought the property for 319,000. So on the first stage, what we would then do is we would release funds in order for them to kickstart the development. So they knock down the old cottage and they then get the utilities in, they start the brick and the block sort of foundations, etc. And as the build progresses, it's obviously going up in value. So our loan to value will be initially at 23% when we start dripping the funds in. It then drops down as the property goes up. We'll then allow the client to draw down the next stage, start the progression of the build. As the build continues to go up, once they get to around about 65% drawdown, we get our valuer to nip back out, and the valuer will then tell us what it's gone up in value. At the early stages of the deal, we always get what's called a development appraisal. So what we will know is what the property is worth now as a slab, first floor, second floor, roof on, first fix, second fix, and then completion. So we will know roughly. Our valuer just goes out and rubber stamps that. So once the client then has got the revaluation, we'll allow them to carry on drawing down the funds in order to complete the development. So once it gets to about the 65% mark again, we will get it then, the valuer just nips out. All right, it's a much, much cheaper option because the value is there for a nominal fee as a revisit. It's not a formal valuation. It's just a rubber stamp on what he's done. At no stage do we have a quantity surveyor. So the additional cost of a QS going out, counting bricks on a week-to-week basis, all ours is by a one surveyor going out. In fact, I've got the project where I'm doing at the moment in time over in Rawtenstall, with a series of 3 barns. I've actually done all the work to date on one valuation. So I don't know if any of you remember the Sarah Beanie programs. This is actually one of them from some time ago, where there was a property sort of built and sort of purchased. But it's just sort of nice and easy just to do it. At no stage does a QS go out and look at these. We've got quite a simple mantra, to be honest. What we'll look at is we've got the valuation, the clients will draw down, they'll develop the site, they'll request more. We'll then get the valuer to go back out if needed. If not, we just bypass the valuation up until it gets to 70%. When we look at the drawdown phases, this is what the value will do. We'll know what the drawdowns are at any given stage. And then we'll work out our loan to value calculations roughly. So long as we're never above 65 to 70, we will let the clients draw down their costings as and when. And this is where the clients will do it just for themselves. If they just fill out the little forms, it's nice and easy. In Kerry's talk, I noticed she mentions about they don't do any credit checks, any credit scores. We don't. We go back to my principles when I was working at the bank. I've never used a credit score system myself. We go on the basis that we look at the collateral. Okay, so we look at each project on its own merit. We look at the bricks and mortar. We look at the land. We look at what it's going to be. We then look at the capacity on how the client's going to repay us back. Okay, has it got the capacity to refinance? Have they got the capacity to sell? Is there a margin in it? We will make sure that the client has got the ability. When we look at doing the loans, I'll go through it in a bit later. We know when we're doing regulated, they've got to have the capacity to repay us, but I'll explain that in just the next slide or two. We also look at the character of the character of the client. The client will have, obviously, the credit file. If they've got a small blip that's been tidied up, all well and good. I've recently done one where the guy had £111,000 CCJ. All right, it was explained. It was a business transaction. He then paid it back. Okay, so we knew it wouldn't interfere with us getting our monies back, and it was something what we looked at. Okay, so we were able to do the deal. The other thing is we will look at first-time developers. Not everyone can get straight onto the sort of the first rung of the ladder in doing development. So if it was me, I can't mix cement. I can change a light bulb and maybe do a little bit of painting. So I wouldn't lend to me. But if I was doing a development, I wouldn't be mixing cement. I'd be hiring a builder. So even though I'm looking at doing a development for myself now, I've got an experienced team coming in to actually do the work. So we wouldn't penalise someone for being a first-time developer if they're using an experienced team around them. Okay, it's to make sure that they've got the ability to look at. When we get a case, whether it be a normal bridging case, we always want an application form, an evaluation. When we're looking at the development side of things, we want to see a schedule of work, schedule of costs. We want to know what the planning permission's for. Is it detailed outline, etc.? Is there any sort of conditions there that need to be addressed? We'll always want to know what building regs are. NHBC, build zone, or any other warranty will be there. But what is absolutely crucial to us is we want to know what the exit strategy is. Is it sale? Is it refinance? And with us being lawyers, we always want to make sure that there's a clean title, because if the title isn't perfected, it could delay the exit strategy, which could incur costs for a client. As I mentioned before, a client, when it comes to a regulated deal, has got two ways of making payments to ourselves. We can either do it as on a retained basis, which we prefer because we then know the client has made the payments, and most exit providers would prefer that the knowledge the payments have been met in some way or another. The clients can pay monthly, but they've got to then approve affordability. If it's on a retained basis, they can't default. I've just taken a little bit of time to do this one because this is very, very sort of a really, really weird deal what we've got, which for as far as I know, no one else does. It's a scheme what we've come up with, which is simply build now, pay later. Do you know any other lender that would lend on a piece of land that the client doesn't actually own as of yet? Okay, now there's been a couple of scenarios with this where it could be Nana and Grandad have got a huge garden, and what they're going to do is they're going to gift part of the garden to the grandson for him to build a property. Okay, so they split title. Okay, the land is now unencumbered, it's now being split. Okay, we can then drip feed the development funds in. So the property then gets built. The grandson then refinances the completed property, pays us back what we owe, gives the granddad the money what he's given for the land, and then they're living in the property. So they've actually built the property without paying it. There is a huge example, which I won't go into, which will take about 10 minutes, but it's where a farmer's sold off land. We've done barn conversions, we've done new builds on a site, and the client has then paid the farmer at the end of development. Okay, so the sum was £2 million. So as long as we can go first charge, the vendor can then stay as a second charge. They've then got an interest in the property as it's going up in value. The vendor can't lose out in reality because the property is going up in value. So their equity is going up all the time. Once the client has then completed, they'll either sell or refinance the property, paying us and the vendor, and then retaining a profit or equity in the property. If anyone wants to know further so I can explain it more clear and a lot quicker, just let me know. If you take a visit to our website, there's a lot of information on it. It'll go through the costings, evaluations, etc., and it'll go through the legals. But the big thing on the valuation, on our website, is this big green box. If you've got a client that's doing a development, get them to fill it in. For the simple reason, it'll give them a reality check. It'll bring it in what's plus and minus 10%. Okay, so they'll know what contingencies there are, what they can do. Okay, so it's really, really sort of eye-opening to some developers because they don't realise some of the costs involved. You've then got what Tony's actually sent out to you, what I call the affirmative white. Okay, it's just a roadmap to completion. But most importantly, when you come to us, as I mentioned earlier, we specialise in barn conversions. We do all types of developments and refurbishments. We specialise in ground up, either it be one unit. The biggest I've done is 50 residentials on a small estate. We do loads of self-build, whether it's a grand design or an eco home. Unfortunately, we don't operate in Northern Ireland, but we do cover England, Scotland and Wales, apart from ultra remote places. We've got our own in-house dedicated legal team. When you submit a case to us, it is manually underwritten, and during the term of the deal, you will have one case-specific underwriter and one case-specific processor. They will hold your hand. You have always got me to come back to if you've got any issues. We do not charge any upfront fees whatsoever. We don't have any QS fees. You don't need experience. If I go to site, if one of the underwriters goes to site, the lawyer goes to site, we do not charge any personal site fees either. It's all down to our experience and all our service. I looked at in the office on the underwriting team the other day. There's 150 years worth of experience. I'm probably coming up to 36 years this year. And as I mentioned before, if you've got an auction purchase that's time critical, or you've put a portfolio holder and you want to boost your portfolio, come to me and I can deal with it for you. All right. That's about it, Tony. And I think it's the first time I've managed to do it within 20 minutes.
Well, I've lost the sweepstake because I had you down for 40 minutes with that amount of slides. So really well done, Ian. That was impressive. There's a couple of questions. I'll be quick on these because first of all, do you lend on agricultural land?
If it's farmland, no. If it's a farmhouse, yes. We don't do land without planning. So, okay. But if someone, I've got an interesting one in Scotland at the moment in time where it's farmland and a farmhouse. The property's that big, it doesn't class. It's too small to be agricultural loan, but it's too big to be residential. So what I've actually done is I've lent the guy 200 grand across the whole title. The guy now is sectioning off the equestrian centre, which are its personal stables, and 10 acres of land to make it a normal house and normal garden. He's then got the ability to get a traditional mortgage to repay me back. Okay, so we can do it on the farmhouse, but not on the farmland. Okay,
and I presume Ian just asked that he presumes you're able to lend on the Isle of Wight?
We can do the Isle of Wight. We've got a huge project at the moment in time, which we've done down there. And as I mentioned before, we don't charge site fees. Eugene actually has been flying down to the Isle of Wight once a month, sort of even driving across during pandemic to look at the project, to monitor it himself. That's our managing director, Eugene, by the way. So when we look at it, it's like tomorrow I'm on another site visit. We'll go there. We do not charge site fees.
Okay, just to answer this final two things, I'll cover these actually in my presentation, but Daniel was asked if he could have a copy of the list of the 18 different ways to use a bridge. So we can sort that out for you later on. That's no issue at all. And I'll come on to the slides because we've been asked a couple of questions about that. Ian, thank you ever so much. I mean, I'm absolutely amazed. 32 minutes for an hour presentation. I thought you said you're going to be talking quickly. I thought you meant you're going to be talking like you're on helium, but no, that was brilliant. Thank you very much indeed. Really appreciate it.
No problem. All right. See you later, everyone. All right. Bye-bye.